Good morning, everyone. Welcome to the Foreign Correspondents Club of Japan. I am Anthony Rowley, former president of the club, and it's my pleasure today to act as moderator and to introduce our guest, who is Dr. Changyong Rhee, who's seated here to my right, of course. Dr. Rhee is the director of the Asia and Pacific Department at the IMF in Washington, and he's going to discuss the economic outlook for Asia and the challenges facing the region. Dr. Rhee has spoken at this club on a number of occasions before, both in his present capacity and when he was chief economist at the Asian Development Bank in Manila. So welcome back to the club. Obviously, when this event was organised well before the coronavirus crisis erupted, but obviously that epidemic has become the prime focus of international attention at the moment. It's still unfolding, obviously, and it's impossible to give any kind of definitive judgment about its ultimate impact. But obviously, most economists are busy scrambling to revise their economic forecasts at the moment. The crisis obviously spreads, in health terms from person to person, but it also has a very profound impact on so-called supply chains, which are very important to this part of the world. But I'm not going to talk about that. We have an expert here to talk about it. I should just say that apart from coronavirus, there are other major challenges facing the Asia region, not least the after effects of the US-China trade war and ongoing regional trade tensions. And so we have Dr. Rhee here to discuss those with us. Briefly, before he joined the IMF in February 2014, Dr. Rhee was, as I said, chief economist of the Asian Development Bank. He's also been a regular policy advisor to the government of Korea, including spells in the office of the president. He's published very widely on macroeconomics and financial economics, as well as on the Korean economy. He holds a PhD in economics from Harvard University and an undergraduate honors degree from Seoul National University. So I'm not going to take up any more time. Let me hand the floor to Dr. Rhee. Just remind you, if you have a cell phone, please put it on manner mode or switch it off. And please join me in welcoming our guest.
Thank you. Thank you, Mr. Rhee, and for the invitation, and thanks for the staff at FCCJ and also our office OAP for arranging this event. It's my great honor to be here at the Foreign Correspondents Club in Japan. Today I will talk about the Asian economic outlook and then also some key challenges, including some of the topics that Dr. Rhee just mentioned. So let's start with our economic outlook as of January. This slide that you see summarized our World Economic Outlook, which was released at Davos in the mid-January. So many things have changed after that, but let me start with this. Will give you some background. I want to emphasize 6 key points in this slide, which is basically reviewing what our chief economist and our new managing director, Kristalina Georgieva, mentioned in Davos. The first fact is there was a quite significant synchronized global slowdown from 2018 to 2019. And the global growth has slowed down from 3.6% to 2.9%. And I'll show you later that it's quite synchronized and actually much heavier, sharper than we expected, partly due to the trade tensions, Brexit, and those kind of uncertainties. Second, our chief economist in Davos mentioned, especially last October, mentioned that the recovery, even though we are assuming that the global growth will recover from 2.9% to 3.3% in 2020, we mentioned that recovery is precarious for 2 reasons. One is that if you look at the recovery in 2020, it's mostly led by some major stressed economies, such as Venezuela, Turkey, and those countries which really had a difficult time in 2019, rather than most advanced economies. For example, if you look at the United States and China and many others, the still economy is going down from 2019 and 2020. So in some sense, by numbers, we are saying that the economy will recover from 2019 to 2020. We say it's precarious because the pickup is mostly led by stressed economies, pickup. And then the third point is that since I'm in charge of Asia, you can see that the Asia slowdown was also quite visible. And then, if you look at the Asia, growth rate was 5.4% in 2019. It slowed down 4.7%, especially if you look at the revision from our October forecast. You can see that we revised down Asia's forecast by 0.3% and 0.2%, both for 2019 and 2020, which is a larger revision than the other regions. So Asia's slowdown was quite significant. But if you look at China and Japan, they are the exception because yes, China's economy slowed down. We expected before the coronavirus started it. We forecast China growth rate will be 6.1% 2019 and 2020 is going to be 6.0%. It's slowed down, but actually we revised upward China's growth forecast because of the phase one deal at the end of the year. That definitely give a better positive news compared with our October forecast. And Japan also we revised upward because of the December stimulus measures will definitely contribute for the Japan's growth rate. But why we revised down global growth rate quite significant by 0.1% in between October and January? I think it's India, which I will explain later, was a kind of shock to us. The sharper slowdown in India and several large emerging economies was a kind of unexpected event, which I will explain later. And then the last point is that compared with the October 2019 forecast, in Davos we mentioned that there is some sign of stabilization. So we are a little bit upbeat because when you look at the whole year in 2019, global economy was slowing down. But at the end of the year, in the fourth quarter, we see some sign of the stabilization. And that is what this title suggests in Davos. When you release it, the title of the 2020 re-update in January was tentative stabilization or sluggish recovery. So we are thinking that there is some kind of bright news coming in fourth quarter. But as you know now, the coronavirus started it. So that I just summarized what was the tone of our messages between October and January. Based on that, let me elaborate a little bit more with the data, and then I'll address what are the new news after the January release of this global economic outlook. First, as I mentioned, in 2019, record its weakest global growth since the global financial crisis, despite supportive financial conditions. In your left slide, you can see that due to the rising trade tension, Brexit saga, and associated uncertainties weigh on business sentiment globally, and then slowdown was synchronized across all regions. As you can see, that it's not just for one region. Most of the region have a slowdown in 2019. And then this slowdown could have been much worse if the major central bank has not reacted aggressively. As you can see, the right panel, over the course of the year, major central bank actually in advanced economies and emerging markets cut interest rate quite significantly. So we really believe that without having this aggressive monetary policy, 2019 could have been much worse. Okay, and then in general, the Asia was hit, as I mentioned, particularly hit hard in 2019, as the uncertainties, trade tension, Brexit, all these uncertainties negatively affected countries with large manufacturing sector, large dependence on investment, and large dependence on trade. So if you think about countries with more manufacturing, large dependence on trade, large dependence on investment, that's Asian countries. So that Asia countries, that is why the growth slowdown in Asia was much sharper than compared with other regions. Especially the trade deterioration in 2019 was quite unexpectedly large. In the first half of 2019, China's import declined by 4.1%, and the economies like Korea, Hong Kong, and Indonesia, the slowdown was, Indonesia case was 7, Korea 5, and Hong Kong is around close to 5. So the trade slowdown was quite manifest in Asia. So I just mentioned the global economy and the Asian economy in particular slowed down quite significantly in 2019. But very ironically and interestingly, still Asia remained the fastest growing engine and the region in the world. In the last decade, if you decompose how much growth is contributed by Asia, Asia contributed about 66% of global growth. Amazing, right? This Asia accounted for 66. But ironically, where the global growth is slowing down last year, the Asia's contribution actually increased 70% because the absolute level of the Asia growth is higher than the others. So relative terms, Asia still remain as a fast-growing region of the world. If you look at this chart, which is based on the 2019 our forecast, 40% of global growth came from China, 13% of growth from India. So if you combine China and India, that's close to 50% of all global growth. 10 ASEAN countries account for about 10% of global growth. You know that currently the US explain about 12% of global growth, and whole Eurozone account for 11% of global growth zone. So we think that the ASEAN is a small region, but 10 ASEAN countries contributing to as much as growth as United States and the Eurozone whole at this moment. So that is why I think still we are talking about slowdown, but still this is why I think Asia remain most dynamic region of the world. So I want to just differentiate the slowdown versus absolute contribution of Asia here. So after this kind of forecast, we see on the positive side, we see some sign of the stabilization at the end of the year. As you can see that in this slide, after the October and November, we see some improvement indicating, for example, like a manufacturing PMI shows sign of the modest pickup in first quarter, both in advanced economies and emerging market. And that is why we are looking for whether the really whole economy is bottoming out. And then we also see that the Asian trade cycle also seems to be bottoming out as well. This slide is not an IMF slide, but I really like it, so I borrow from the Goldman Sachs, the PowerPoint, and they shows that recently Asia trade has a 3-year cycles, and it shows the period, and then the current cycle, which started in around in 2016. If you believe this 3-year cycle seems to be at the end of the bottoming cycle and then maybe pick up. So that gives some expectation that growth may be stabilized in 2020. And at the same time, in 2019, the most growth was led by the central bank and the more expansionary monetary policy. And we are expecting that the financial condition is expected to remain accommodative for a while. For example, like market believe that there will be a more basis cut of the policy rate in the United States, and now many people believe that policy rate in Euro area, Japan, and Switzerland will remain negative for a while. So the accommodative policy stance will continue. That also raised expectation of market stabilization in 2020. Then suddenly, I think unfortunately, this expectation of stabilization in 2020 become quite uncertain now due to the unexpected spread of coronavirus. And first of all, before discussing, I'd like to express our deep sympathies to the people in China and other countries who are affected by the coronavirus. Like others, we really hope that it can be contained soon, and we are closely monitoring the development. I know many of you came here to ask me what is the number, what is the growth focus, all these things. I have to disappoint you first, okay? For us, let me be very candid. We do not have much information to be firm about our number yet because it's still evolving. And then when we look at the various models, the quantitative impact really depends on how soon this will be contained. So if you have to do some numbers, you have to assume that when these things will contain. But that is still very premature, very uncertain. It is not our expertise. And as an institution, we have to be a little bit conservative. We do not want to say that, oh, if you assume this is contained by certain date, this is impact, that will, in some sense, it is irresponsible. So we are internally addressing this issue. I think we may have to come up with some of our new forecasts based on the new data. And but probably, our MD will discuss this issue in Saudi Arabia on the margin of G20 next week. And then we have to produce our numbers in early April for our World Economic Outlook. So we are really monitoring, but at this moment, it will be very difficult for me to say you that these are the numbers that we are thinking, because we don't know how soon this will be contained. We know that the China government is doing their best, and they did a great job. We hope that they can contain this spread very soon, but it's too premature and too early for us to have some quantitative result at this moment. Overall, I think, but we can say that, definitely no one will deny that these events definitely increase downside risk. Okay, especially the downside risk will be large for countries which has a close ties with China, which basically Asia. At this moment, I think major channel that has impacting in Asia is tourism, as you know. And then some Asian countries has a quite significant proportion of tourists from China. For example, I think the Hong Kong economies in Hong Kong, I think it's more than 70% of their tourists come from mainland China. Korea, Japan, the share of the Chinese tourists is well above 30%. Thailand is around 20%, but I think the impact can be quite large because Thailand dependence on tourism is quite large. And then it's not just Asia. If you look at the European countries now, they are really seeing the many tourists from Chinese dropping. But it's not just Chinese tourists, because many people will be cautious in traveling. So the first line of impact will be through the tourism and service sectors related with that. And then that really depends on also how long this is going to be last. So let me say that at this moment we are working on it, but it's a little bit premature to give a more detailed channel or detailed impact as of now. So maybe disappointing, but I have to be very careful, very candid that this is ongoing events. It's a little bit premature to judge. Another issue that you mentioned and many people are asking is about the phase one trade deal. What will be the impact? And so I want to make clear from the beginning, because when I mentioned this slide, many journalists actually reported, a little bit, differently from what I wanted. So you are here, but I want to make it clear so that I won't make a miscommunication. First, if you ask me, what is the impact of the phase one trade deal that was reached at end of last year? The impact is net positive. Why? Because we are so worried about trade tension escalate. It can affect the trade volume. It can affect the confidence effect on market. It can also affect the financial market. That we all worried about it. But last, November and December, when the deal was reached, definitely through the trade channel with slightly lower tariff, and then the market reacted positively. So through confidence channel, financial market channel, and trade channel, net impact is positive. So technically speaking, we say that before this agreement was reached, we say that U.S. trade tension, which was announced before, could have reduced the global growth by 0.8% in 2 years. But after this phase one deal, we say that it has a positive impact of about 0.3. So it has a 0.3% increase compared with our initial focus of minus 0.8%. So it's a positive impact. So that has a definitely positive impact. But every silver lining has a touch of gray. So what we are worrying about at this moment, concern, is about among the deal is so-called managed trade aspect of this trade. Why? Because the China and U.S. agree that China will buy 200 billion in 2 years more import from United States. Then the question is that whether China will just increase that import, not reducing the other import from the other countries, or they have to kind of shift some of the import from other countries to the United States. That bilateral aspect can have some concern to other countries. And then, we really want that this trade deal was done by the multilateral way rather than bilateral way. And that is our concern. So to illustrate, some potential impact of this trade diversion. I mean, trade diversion has an impact, but I do not mean there's a net positive impact. But depending on the countries and sectors, there can be some countries, some sectors can be affected. So I want to emphasize net positive first, and then I'm going to illustrate these examples. This slide shows the major non-U.S. exporters to China for the key product that China and U.S. has agreed to have increased the more import from China. Take a look at the aircraft in the middle. Okay, in 2017, the U.S. account for more than half, 58% of China's total aircraft import from the world. That's on the left blue bar shows. If you look at the right side, and then the other major exporters of aircraft to China is France and Germany. They together account for 38%. So why I'm kind of intuitively, so if China has to buy more airplane from US, then I think who's going to be major, whose country will lose more import? Well, naturally, I think it's maybe France and Germany. That's how we construct these tables. If you look at the electronics at the top, import from the US is only 4% of the total electronics import, while the three Asian countries, Korea, Japan, and Vietnam, account for about 40% of China's total electronic import. So if you look at all other items, basically this slide shows that Asia countries could be significantly exposed to this trade diversion, excluding few products such as agriculture and energy. But if it's energy, then Saudi Arabia and others can be affected. So what we are saying is that it depends on lots of assumption. If this trade deal make China open more their economy, they absolutely increase more, do the structural reform and improve the import from the global market, everyone will win. But somehow China is diverse some of their more purchase from U.S. to other countries, then there can be some redistribution, and there can be a negative trade diversion effect depending on the country and sectors. So probably our April report will address this issue a little more in detail. And then another issue when we actually analyze its impact on Asia is the spillovers from China's stimulus, and partly due to the trade tensions, partly due to their own slowdown of the economy after deleveraging, partly due to the coronavirus. We are expecting that China will rely more on stimulus this year. But one fact is that the multiplier of this China stimulus has changed a lot over the course of the years. Unlike their biggest stimulus in 2008, unlike their stimulus in 2016, which heavily depend on the infrastructure investment, and as a result, it has many import contents on the stimulus. But now, if you look at the current stimulus package in China, desirably, and this is the right thing for them to do it, they focus more on building social safety net, tax cut. So it focuses more on the domestic side. So even if they are doing the stimulus, the spillover to other ex-China Asia will be now relatively smaller. So that is why this, even the China slowdown, they make a more stimulus to make the growth rate not changing very much, but the spillover to other Asias can be not as big as before. That was another concern that we had. And then the other issue is we call low for longer. As I mentioned, that the low interest environment has helped Asia's global growth in 2019, and it will help 2020. In the short term, is true because lower global growth, global interest rate helps the capital flow, into the region, and they will definitely give a more policy space for many central banks in Asia. On the other hand, but this low interest rate for a very long period, and now we're expecting that this will last quite long. So some people say it's low for forever. So if this continues, then there is some financial stability risk can come. As you know, that there are many companies, financial institutions are searching for the yield, and many lower credit rating companies now can access the liquidity. And one of our study shows that according to our GFSR, Global Financial Stability Report, debt owed by the firm unable to cover interest payment could rise to 19 trillion. That is almost 40% of the total corporate debt in the United States, China, and European economy. So when the credit rating of the debt and increasing of liability definitely is a medium-term concern. And that is not an exception in Asia. And if you look at it, many Asian and many emerging economies has also in the last decades increased their leverage quite a lot in the government sector and corporate sector. So yes, the interest rate will remain low, but eventually if there is any change in interest rate, that can be a source of instability globally and in the regions. That's why you're considering. I know it's almost 20 minutes, so let me just issue a couple of more minutes and just discuss the country cases. Since I'm in Japan, I want to also talk about Japan. China, because we already discussed, I'm pretty sure that you will ask many questions. I make my slides short. One thing which I want to really emphasize that people believe that China's slowdown is mostly due to trade tension and coronavirus this year, but it's not. China's growth rate has been moderating because of their structural effort to deleveraging. And even before the trade tension happens, China, rightly so, rely on more the structural reform to reduce their credit expansion, deleveraging, and that trend make China's growth rate slow down. And then on top of it, this trade tension and coronavirus make their effort will be very much harder. But we believe that this is inevitable course. So yes, we understand that if the coronavirus cases slow the Chinese economy slow down quite more, then they have a fiscal room, they have a policy room, they have to do the stimulus. But we really hope that they can also do the same structural reform and credit control, so that they can they do not revert their intended effort of financial market and the deleveraging in many shadow banking and those kind of things. So China has a very balanced and difficult task this year, how to balance the fiscal stimulus and the monetary stimulus to stabilize the economy, but at the same time structurally they away from the credit-driven growth and how to do the smooth transition in deleveraging. That's a very important task. India, I mentioned that India was a shock, because if you look at this graph, if you look at the business sentiment, very unfortunately, after we released our number in October, business sentiment suddenly dropped. So I was in a very difficult position, because why I say that your forecast was so. So if I have a complaint, one thing that many investment bankers publish their growth forecast every month. So when they see October, this number, they slightly significant change in November forecast, so it looks good. But our growth forecast come from at least 3 or 4 months later. So in between, our numbers looks very high, and we make them look very bad. But I think it was very hard to understand and also see why the India's growth rate really slowed down. We are forecasting India's growth rate this year 4.8%, and which will be recovered to 5.8% next year. And there are many reasons. Many people say ex post always economists can justify these things, but definitely I think the credit crunch and the sharp slowdown of the credit in the non-banking financial sector, in shadow banking sector in India, definitely contribute sharper slowdown. And so one good news is that we are now seeing that the most recent PMI numbers shows that growth is picking up in India. So we will see whether the India's growth rate will move back to their potential growth rate in a short period of time. And we are watching very closely. So we hope that India can continue their structural reform together with some stimulus, which make the India's growth rate back to well above 5 to 6% on their path. In Japan, I think growth is projected to 0.7% to 2020 and 0.5% in 2021. Is supported by, as I mentioned, domestic demand and fiscal stimulus packages. But at this moment, because of global financial conditions, risks are tilted to the little bit downside. There is, export sectors, export growth is slower than we expected. I heard many report about the Q4 number, sharp slowdown in Q4, and many people say that because of consumption tax increase, Q4 growth rate in Japan is much slow, and all those will report. But let me assure you that this Q4 number that was just released is in line with our current forecast, because we expect that after consumption tax increase in October, there will be definitely some decline of the consumption, especially durables, and that amount is much weaker than in 2014 episode. And then that so far what we are seeing in the currently the Q4 number is consistent with our growth forecast of 0.7% this year. Whether there will be any downside risk of 0.5% to 2021, I think as you mentioned, the coronavirus and global economy will definitely affect the Japanese economy, so we have to see it. But at Japan, if necessary, we believe then do some more fiscal measures to maintain the growth rate. So at this moment, I want to mention that since we got a lot of question whether Q4 number was much more negative than we expected, but I want to say that this is in line with what our expectation after the consumption tax increase. And this slide shows that the low for longer is a lesson. Many countries can learn lesson from Japan for low for longer issues. I mentioned that one of the global issue and the Asia risk, one of the risks that Asia will face is a low interest rate for longer period. And Japan shows a lot of examples and a lot of experience it, especially compared with many Europeans and other countries in the last decade. Interest rate has been going down from the high level to the lower level. So yes, interest rate goes down, but because the interest rate going down in this past, there can be a trading benefit. Many banks and others can still gain by trade by the low interest rate. But once the interest rate gets stuck in a negative level for a long time, then it will affect the financial markets, profitability, the insurance company and many small banks. That's what actually now currently happening in Japan, because Japan, unlike many other European and advanced economies, Japan's period of declining interest rate has been happened a long time ago, and Japan has been a lower level of interest for a long time, and that really is kind of giving us stress for the many local bank in Japan, and their core profit is much affected, and now that's why the Japan government is trying to find a new source of income diversification and growth for the local bank. And these are exactly the issue that I believe that down the road Europeans and Korea and many other Asian economies will be facing. So in that sense, I think the world can learn or lesson or non-lessons from Japan how to handle these issues. Okay, and we believe because of that, I think in Japan, structural reform is most important. In Abenomics, we believe that the Abenomics 2 arrow, fiscal policy and monetary policy, did a great job and laid the ground for the stronger growth. But I think still only monetary and fiscal policy can continue forever. And then Japan definitely need to have a third arrow to be more effective. And we emphasize the labor market reform, corporate sector reform, trade reform. And I think given our time constraint, I do not want to go to details, but you can see our Article 4 report, which was released 2 days ago, and then it discussed a lot of the structural reform agenda that we discussed with authorities. So with that, let me close my presentation. Thank you.
Thank you very much. Very comprehensive and very concise. Okay, we'll turn to questions, firstly from the working press. But perhaps I could briefly ask you a question myself first, because I know this is something of interest to you too. We see now every day, almost in every column of the newspaper, this term supply chains. And every time there's some kind of crisis, I mean, I remember in Fukushima in 2011, the SARS crisis, and then the Donald Trump trade wars, and now we have the coronavirus. Every time these crises occur, a great deal of attention is paid to these supply chains, but no one seems to be really clear about the structure of them. So how vulnerable are they? I mean, and is there any way in which greater information on these supply chains could reduce the vulnerability of the economies to the disruption?
I think this is a kind of, I can see the two different questions from what you just say. If I have to analyze what will be the short-term impact of current supply chain through the coronavirus or some other external shock, as you mentioned, flooding, all these things. Then we have data and we have a tool. There is many literature which analyze the supply chain of the Japan's earthquake and also Philippines, flooding and past, in Thailand flood, and based on the manufacturing base and the interlinkage of the countries. That data, based on the I call first generation of the supply chain, is there. You can do that. But I think what currently people are talking about is slightly different from this first generation supply chain. First generation supply chain is based on the more manufacturing sector and also based on the low wages. And then also intermediate good. So global companies trying to find the places with low wages, having more investment. And so China become a hub of intermediate good and assembly, factor of Asia, those things. Those are the kind of first generation supply chain. We have seen a lot of literature and we have data on it. So based on that, we can do the analysis. What will happen to the this coronavirus, all these things when the supply from China to I heard that several auto companies in Japan has recent some short-term difficulties from getting input from China, right? Those kind of things we can do the analysis, and there is data. But I think what people are talking about at this moment is not that one. But people are talking about is more technology. And then if you look at it, even for the people, so there are political reasons why many companies have to diversify their factories, and also technology has changed a lot. So even if it's manufacturing sector, they do not usually hire more labor than before. If you go to the Vietnam car company, I see there's only robot. I mean, when I see the 1780s, we see a lot of people in Korea and working for the car company. So instead of the labor cost, now the people thinking about technology, and we call servicification of the manufacturing, and then IT. So people are looking at which country has a more good infrastructure, which country has a more political stability, which country has a better infrastructure, better human capital. And then those things are combined, and whether we really see the trend of this moving. As a APT director, I talk to several businessmen, so I can assure you there is a significant discussion. Do I see it, have a data? No, not yet, because this is going to take time. So I think this is one of the reasons why in the last APEC summit there is some disappointment of India's the RCEP participation, because many investors thinking about how they can link these things to the new supply chain to ASEAN and India, because India in the sense has a good IT companies, IT infrastructure, so they can actually many businessmen think this is another opportunity to develop the new growth global value chain. So what I'm saying is that when we talk about global value chain, we have to really think about the past global chain and or the future global chain. And that one is the future side. There are a lot of discussion, but as you mentioned, I don't see any very good empirical work on that topic.
Okay. Thank you. Okay, questions from the floor, please. If correspondents don't have questions, then we take questions from anyone in the audience. Oh yes, please go ahead. Yes. Can you go to the microphone, please, and give your name and your affiliation, please? Thank you.
Hi, Reiko Kihara from Reuters. Thank you for your very thorough analysis of what's happening in Asia. I have two questions. The one is, I know it's very hard to quantify the impact of the virus spreading, but you talked a little bit about the impact on tourism. There's another thing that worries a lot of Japanese companies, which is the supply chain disruption. And given that Asia is so reliant on this component, if you may, can you elaborate on the potential impact on factory output, trade overall on Asia, because it's only starting to bottom out. It's still very vulnerable. My second question is about the low rate for long. There's a lot of talk about Japanification among major central banks, whether they're down the route of what Japan experienced. You elaborate a little bit about it, but how serious do you think the negative impact on regional banks have become in Japan? and whether there is a very specific solution the central bank can provide, or whether it's just a matter of dealing with it with macro-prudential tools. Thank you.
For first question, I think I'm very sorry because, as I mentioned, we know this supply chain, not only the tourism can have another channel, but in order to see how serious this is going to be, I have to know when it's going to end, when the spread will end. Now, Chinese decide to stop the people are returning from the Lunar New Year holidays. They're trying to produce it, but depending on what will happen, so it's kind of hard to see what will happen from now on. So I'm very sorry. We know that theoretically that this channel is serious, but whether it's going to be really how serious it's going to be, we need to see it a little bit more. So that one, I think, very hard to comment on it. As for the low for longer, I think Japanification, intuitively correct, but in my opinion, whether Japan case can be a good example for the other central bank to learn and the global can learn at this moment, I have some mixed feeling. Because when Japan has this own problem of the slowing down economy and population problem and the low interest environment in Japan, I think the solution for Japan too is very easy. The global interest rate is high, so you actually invest abroad. So that take care of a lot of the large part of the problem. But now when you get to look around, all the interest is low. So low for longer is for everybody. So whether the other countries will face the similar problem can have a luxury that Japan had by investing abroad. I don't know. And then yes, you can invest in an emerging market, but definitely that has a high risk. That's what I'm saying, that I show you the low interest environment can increase the risk taking. So these are the issues that the currently advanced central banks are discussing. But my point is, I want to emphasize that this is not just for the Japan and advanced economies question, such as like in Korea, but many Asian countries, emerging market will face the same thing because whole global economy will have a very low interest environment. For specifically for the regional bank in Japan, I do not mean that at this moment this is a serious risk factor. But if we believe this situation will continue longer, then definitely there is a new business model. You cannot rely on because previously you can rely on the more input from trading, but you cannot do that anymore. So that is why the Japan government that we are discussing, and the currently Japan government try to find the new business models for this local bank. But I think this is an issue. If you look at the many other Asian economies, even emerging market economies, similar issues coming in. So I'm not saying this is an immediate risk factor, but what I'm saying is that Japan's example can have some implication. And when I say non-implication, that I mean the difference between the previous case in Japan.
Okay, good. Yes, does it.
Thank you very much for a very interesting presentation. I have a...
Sorry, identify yourself.
My name is Kurt Sieber, associate member. This is perhaps a little bit delicate question, but I would like to ask you, what can be done to improve the relationships between Japan and Korea, which is still on a very high tension, and efforts seem to be made in the direction of kind of lowering the tension, but your specific input to that would be greatly appreciated. Thank you so much.
I have to really, this one, it will be very difficult for me to comment. So there's a conflict of interest, because I'm a Korean, as you all know. So, but I really hope that this can be resolved very soon, and in an amicable way. And that is why we have a high expectation on both leaders. And the leader's role is to de-escalate the tension, and I really hope that they can resolve this issue very soon. Other than that, because of conflict of interest, let me pass this your question. Sorry about it.
Yes, does it.
Thank you very much for the excellent presentation. I'm John Armand from the Canadian Embassy. I wanted to pick up a little bit. You mentioned the sort of second generation supply chains and the problem basically of not having data. But I'm curious whether you're seeing in sort of your overall economic projections increasing uncertainty in the models, which you may be thinking is because of data and technology issues which aren't properly captured by current models. Thank you.
Actually, I say that what I say is that I cannot see this trend in the data, but I can see the trend already started. And actually, I think because of the uncertainty that you just mentioned, this trend will escalate. Because if you look at why this is happening, is basically two things: political uncertainties, the country relationship. The political uncertainties definitely give the incentive for the companies to diversify their source, so their uncertainty effect, and also technology uncertainty. What kind of technology will be available, for example, and then also many people say, this is what I'm saying, that without data that people are talking about. So previously it's more like a current mass production of the standardized manufacturing good, but with a 3D printer, people say that maybe companies are trying to match the local demand more on a time basis, with a smaller production, with higher prices, more value added. Those things have really changed the business strategies. And all I'm saying is that now the competition, which was based on the focusing only on manufacturing and focusing on the low cost, that model seems to be gone. When I have a discussion with many businessmen, they are not looking for some country with just low wages. They are looking for the more the better infrastructure, better education, and some social responsibility of the corporations, green growth or other things. So the business model seems to be changing quite a lot. And then I would rather say, when people talking about, if the people, there's no redistribution of the redirection of the supply chain from China-centric factory of Asia model to other countries, we talk about Vietnam and others. But I think Asia countries has to be reminded we are not just competing among Asians. Now Africa can be another source of the supply chain. Eastern European countries do. So previously say, Asia's labor cost is cheaper, so we will have it. That does not necessarily will go through.
Yes. You mentioned that after the Phase 1 trade deal, that confidence has improved somewhat. But nevertheless, the political situation is still very uncertain. It's still, trade tensions are still there. I mean, do you see any evidence that this is affecting capital investment? In other words, that companies are holding off new capital investments because they don't know what the trade environment is going to be like?
Yeah. I think this year, I think one of the real issue is the geopolitical risk, and there are a lot of the elections coming in the world, and then also there are lots of social tensions going on. So I'm pretty sure that and now together with the coronavirus and then these uncertainties, I think business investment will be slow because of the extended uncertainties. That is why we believe that this trade issue has to be resolved in a multilateral and rule-based way. Because if you really rely on the bilateral solutions, still, depending on the conditions, this may not address the uncertainties impact on investment issue very well.
Okay. More questions? If not, I have one more question. That is coming back to supply chains. Is there any evidence at all that companies, do you think, or countries are thinking more of localizing production? In other words, every time there's some natural disaster, by which I include epidemics, for example, or political disaster, these risks come to the fore again. Do you see any evidence, even anecdotal, that manufacturers are considering increasing the amount of local manufacture so that at least it's in their own country and not subject to the vicissitudes of external events?
Yeah, that's what, Anthony, I think that's what I'm interested to know. There are lots of discussion about it. This is one of the examples why I mentioned the 3D printer issues, but I don't see the data. So I think there are a lot of discussion. That's what I'm saying. It's a little bit premature to confirm those things. So we have to really see it. But I think we will see I think you will see the continued globalization, but it's a different way of the globalization. And then even if I see that I'm more familiar with Korean companies, so when I see this new value chain with China, for example, previously many Korean manufacturing companies went to China to produce intermediate goods. But now if I look at which company is going to China more, they are targeting more consumer base of China. So, for example, now we have a Oscar product. So, many company who has a movie channels go there. Many company who has a bakery and some local target. Those companies come. It's quite different, strategy. And at the same time, also Chinese company become quite competitive. So previously, China was a recipient of a global value chain, but China is a part of the global value chain. It's the supply of global chain. 5G, for example. So we see, we will see different player and a different pattern.
Okay. Right. Questions? Yes, Shihori-san, dozo.
Just for clarification, I'm Shihori Komatsu, freelance caster. Yesterday, according to Reuters, there was Chinese experts saying that the coronavirus may be over in China by April, and it is possible that the peak will be in February, mid-February to the end. And I was just wondering, and then plateau and maybe end by the end of April. So based on that hypothesis, could you give us some predictions, your ideas on the economic numbers and maybe timeline on the economic impact on that hypothesis?
I think I have to rely on our team. Okay, I think here. I think it's really premature to give my own opinions. Our team is working on it, and we want to have more data when whether that assumption is correct or not first. Okay, we do not want to jump, and we do not want to have some hypothetical numbers. So our team is working on it. So today I know that you can't afford to get a number, but for this issue today I cannot mention the number.
Okay, all right. One more question from me, which is my last, I promise you. It seems that consumption has been holding up remarkably well, personal consumption, not only in Asia and Korea, for instance, but in America too. But how much is it based on borrowing? I mean, the debt is rising very rapidly, and if rising consumption or buoyant consumption is based on rising debt, isn't that going to lead to some crunch somewhere down the line?
That is exactly what we have concern, because the low interest rate in every year increase the asset prices. For example, stock prices in many advanced economies, real estate prices several in Asian economies, and that asset price increase definitely help to support the consumption growth rate. And then now, given that the economic slowdown, interest rate will remain relatively low, so that trend may continue. But this is related with many policy issues. If you believe that the interest rate will be forever lower than the growth rate, you can borrow. It's a free, you can borrow, and then you can increase that. But still, given that interest rate lower than growth rate, you can keep on going on. But the assumption is that whether interest rate will remain forever than the growth rate, and what should be the kind of caution you have to take. This is related with not just for consumption, but related with especially for like Japan, whether Japan can have a more fiscal space to increase your debt over GDP ratio, whether you need more consolidation. And this is a debate that what we are having in many European countries also. If you really believe that the interest rate will be forever lower than G, then maybe fiscal policy can have more room. But is it a safe assumption? And these are the kind of current debate we are having.
But where does the crunch come? Does it come when the household says, I've borrowed so much, I can't possibly borrow anymore? Or does it come when the bank or the finance company says, you've borrowed too much and you can't have any more?
I think to me, because this is currently very academic and theoretical policy debate, I do not want to jump to the conclusion because there are many different views. But I can assure, as an APD director, I can assure you that for a country which do not have an international currency, they have to be extremely careful, because the country who has like Japan and the U.S. and Europe, when you have your own international currency, sometimes you don't have a pressure from the foreign lender. But on the other hand, many Asian economies which doesn't have an international currency, if their debt level increases, there's an issue for the especially the foreign currency denominated debt increase. But even your domestic debt increase, you cannot print out the money.
Right.
Many advanced economies has a luxury of doing the QE when the things coming in because they have international currency. That's what we have seen it. But if the country emerging economies which do not have an international currency, if they do the QE, then the exchange rate depreciates significantly, and then that will make a burden of external debt larger. So I think that some kind of unresponsible remark that the whole world interest is lower, we have to use this opportunity to increase our debt and using for growth, may be true for some relatively small number of the advanced economies which has ability to do QE. But I think I would rather say it for many Asian policymakers who doesn't have that luxury, be careful and be conservative.
Okay. Right. We have 3 minutes left. Yes, Dosa, please.
Thank you, Suika from Reuters again. Just listening to your latest conversation, wondered if you can elaborate a little bit on how the emerging debate about digital currencies disrupting financial systems, digital currencies, how they could affect the financial systems and capital flows, because the fear among the G20 nations is that digital currencies or stable coins like Libra could potentially disrupt capital flows and economies for vulnerable emerging nations. Do you see this as a real threat in some of the Asian economies, or is it too premature to make any judgments on the potential impact? Thank you.
I will refer to several studies that now IMF is doing together with the BIS and many other international organizations, and the G7, G20 countries also address this issue. I think currently, we think that like Libra, like this digital currency, we start to call them digital asset, not a digital currency. We find that this private digital assets has several deficiency to be an international currency, even though it may be localized, it can be used for some countries which doesn't have any trust on their monetary system, all these things. So yes, we know that there is a need to reduce the transaction cost across the countries, so those things has to be addressed. But whether this privately oriented digital asset can be a global currencies, we see as of now many problems. That is a kind of tentative conclusion. But your question, whether the central bank driven digital currency can be an alternative solution, there is a lot of debate now. And I think there is more room that can be developed. And then the objective has to be not only but within country, you see there are many digital currencies already used, digital asset used. But the eventual goal is whether the central bank introduce digital currency can really reduce the cost of international transaction. That was actually open the niche market for this private digital asset coming in. So that one, I think we have to see more debates. And currently, that is a current stage of the debate.
Okay, well, time is up, unfortunately. Thank you very much for coming to talk to us. Actually, we normally give 1 year honorary membership. I'm sure we're going to give it to you later, but
thank you.
Please, in any case, please come back again soon and give us an update, especially when the figures on coronavirus become more clear. But
my apologies, also. I know that you all come from the number, but
but seriously, thank you very much indeed, and we look forward to seeing you again soon. Thank you.
Thanks for the invitation. Thank you.